I think you're going to have a fairly deep recession, and we're only at the early stages of it here in the U.S. So I think it's pretty early on still before you see the large jumps in the layoffs that will occur. Now we're starting to see that job cuts are increasing. The challenger numbers are up multi-month high here, and so we're seeing that, but it's going to get a lot worse. We're not even halftime, I don't think, at this point.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Heading into 2024, we may be witnessing a change in a number of trends. The October CPI numbers suggest inflation is moderating faster than expected. If that proves true, this may mean the Federal Reserve's aggressive campaign of hiking interest rates is over. And if that's true, the 3-year beating the bond market has suffered may be coming to an end. As for stocks, they've been powered higher all year by the Magnificent Seven, but even there, we may be witnessing a regime change. To clarify whether these are indeed real and significant trend shifts, we're fortunate today to speak with Fred Hickey, editor of the highly respected newsletter, The High Tech Strategist, which Fred's been publishing since 1987. Fred, thanks so much for joining us today.
Oh, always my pleasure.
Well, a pleasure to have you back here on the new channel. Fred, you're one of the very first guests. I can't think of anybody better to kick this new channel off with, so thank you for making the time to join us here. Lots of questions for you, lots of new news to react to. Very quickly, though, just to set the context before we get into the details, a general question for you. What's your current assessment of the global economy and financial markets?
Well, it's a lot worse than what the consensus is right now. Internationally, I think major parts of the economy are in recession already. Certainly that's the case in China, and also in the case in parts of Europe. Germany is in recession. The largest countries in Europe are in recession. France is following it. And then you have the US, which, last quarter showed a 4.9% GDP number, but the latest Atlanta Fed fracker is 2%. I think the economy is a lot worse than some of the headline, that 4.9% number, GDP number shows. You could start with consumer spending, which is 70% of the economy. And we have a lot of data that's come in, including Home Depot this morning, a lot of data. But Home Depot, once again, came out and said that their sales are down. They're expecting 3 to 4% decline. Obviously, they're being hurt by housing because housing is in a deep recession, given that rates have soared there. We're talking about 7.5% mortgages versus 3+ before. So housing, which leads the economy usually, is in a dark place. Mortgage applications a week or two ago went to 28-year low. Existing home sales are down to a 13-year low. We've seen a drop off in industrial production. And I was going to say in consumer, we just had a great report come out yesterday. It's a new one from the National Retail Federation that that instead of, like, the government tracks, it does a survey, and they'll have that report this week. This one actually tracks transactions. So 1,400 institutions, financial institutions, $500 billion of sales, 9 billion credit and debit transactions. So it's accurate data, not survey data. And there they showed a decline in retail sales in the month of October, month over month, and it's been slipping now since April. Bank of America had a similar report out last week, and they showed also a 0.5% year-over-year decline in retail sales. So consumer sentiment was out last Friday, University of Michigan, that was a 5% decline to 60%. That's showing, that was fourth straight month of decline. So retail sales are weakening. There isn't any doubt about that. And of course, when you raise rates as much as they have, as much as the Fed has, starting in 2022, it was going to have an impact, and it is having an impact, but it's maybe slower than some expected, including myself.
Hey, Fred, sorry, just on that point, because you're hitting on my favorite topic here, which is the lag effect.
Yes.
You're essentially saying it acts with a lag, and this lag is taking longer than many folks, perhaps even yourself, expected. I'm just curious. I'm just asking you to guess here.
Mhm.
How much of the lag effect has expressed itself to date?
Uh, well, when I was on this show 7 months ago, I said that, that I thought we would head into recession here at the end of the year into 2024, but it could be extended out if the Fed acted. And shortly after that, well, at the time, the Fed's balance sheet was 8.3 billion. They had taken it down via QT from 8. I should say trillion. The billions and trillions can get confusing. 8.9 trillion down to 8.2 trillion. It was 8.3 when we spoke. And then over the next few weeks, they took it up by $700 billion. They injected money to combat the regional banking crisis. And that helped extend everything out. We had that huge surge in money that came into the system. And that caused the lag to be longer, I think, than would have occurred had the Fed not. And that's what I warned about. If they did that, then they could extend everything out. But I think now things are turning down. And I don't think the Fed can act again right now. Well, you just saw that, as I mentioned, the University of Michigan, they also have an inflation expectations component, and that came out on Friday, and that went up for the next year from 4.2% to 4.4%. And long-term inflation expectations also rose from 3 to 3.2%. And when that happened, all the Fed all the governors came out and sang from the same hymnal and said, higher for longer. Mm-hmm. And we might have to raise rates. So I don't think you're going to see rate cuts as soon as some of the market would hope, because there are inflation expectations, a big part of inflation, but you also have the Atlanta Fed wage tracker up to 5.2%. Today's CPI report still shows 4% inflation, excluding food and energy, and it's 3+% in the headline. That's still much higher than the Fed wants. So I don't think the Fed can come in and save the day. And the erosion effects of these higher rates of QT, because now the Fed has taken their balance sheet back down, it reversed that 700 billion plus some. So we've gone from 8.9 trillion to 7.8 trillion right now. That's a big $1.1 trillion decline, and it's dropping by $90 billion a month. So the tightening continues. And all these companies that used to borrow at half the rate they can borrow at today, now it's 10% in many cases or higher if it's a junk bond. When they go to refinance, their interest cost goes way up, and it's causing companies like WeWork last week, was a very large company, has a large real estate footprint, for that company to go bankrupt. So we're going to see these kinds of erosionary effects. It's all lagged, but it's still happening.
Great. So you're taking this exactly where I wanted to, and I'm going to ask my question in a slightly different way, which is, the lag effect is the Fed takes action, but it takes a while for the impact of that action to manifest in the real economy. And right now, the Fed has been trying with its rate hike campaign and QT to slow the economy, right? So it's increasing the gravitational force pulling economic growth down. So as you're saying, there are all these reasons, especially the longer we stay higher for longer, the more that force of gravity is going to start just pulling everything down with it.
And one of the problems with the lag effect is that their numbers lag. So everyone looks, and they see GDP at 4.9%. Well, I don't think we're going at 4.9%.
Right, doesn't reflect where we are today. Yeah, exactly.
Right, and so that's why you have a lag effect. I mean, you have in jobs area, you've seen some growth there in jobs. The jobless rate has gone up from almost 0.5% now to 3.9%, but they're still showing strong jobs growth. Well, last month's numbers was all due to birth death 414,000 jobs. Those are phantom jobs.
It's just monkeying with an Excel spreadsheet, right?
Well, no, I won't say they're monkeying it. It's their methodology. What happens is that when they add or subtract these jobs, depending on what their forecasts are, where they think the economy is. Well, if we've been in an upturn, they add jobs. They don't see the downturn, so they keep adding jobs. even though we're not really adding jobs. So it's 414,000, and this has been going on. So the jobs numbers are all inflated, and those are the things that they show, even though we do have an increase in the unemployment rate happening. And there's a lot of other jobs related that, temporary help is declining. There are a lot of other items in the numbers that are showing that there is a decline, but the big headline numbers are showing strong growth, and that's why a lot of the people in the stock market calling it a Goldilocks economy, because they think the economy is strong, and it really isn't.
So in many ways, we're kind of looking at data that is flawed, right? So
Correct.
just to finish my question here, so lag effect we still have yet to see all of it. My question to you is how much has yet to manifest? And I'll make it easy. Have we seen more than half of the impact yet, or does more than half of the lag effect impact lie ahead of us? Like how much lag effect should we be bracing for is kind of what I'm trying to get to.
Well, I think you're going to have a fairly deep recession, and we're only at the early stages of it here in the US. So I think it's pretty early on still before you see the large jumps in the layoffs that will occur. Now we're starting to see that job cuts are increasing. The Challenger numbers are up multi-month high here. And so we're seeing that, but it's going to get a lot worse. We're not even halftime, I don't think, at this point. My best guess.
Not even halftime. That's exactly sort of the general ballpark I was looking for. Okay,
right.
Thanks.
2024, and again, unless the Fed comes in and I don't think they can right now, unless they come in and try to extend this out again. I think we'll continue down into 2024.
Okay, so then one question on that is, I want to tie it to the recent October CPI numbers that came out that you just mentioned, where they did surprise on the downside. They were less than folks expected. There's a great chart I'll try to find in a moment here that Zero Hedge put up, showing how the CPI tracks with M2 with a delay. And if you look at where M2 has gone, it suggests that the CPI is going to continue going substantially lower even from here, right? And so this data the discussion this week is, hey, this has put the nail in the coffin on the Fed's hiking regime, which means not that it's going to cut anytime soon necessarily, but it's going to remain at this plateau, right? Higher for longer, right? Now, history shows us very clearly, when you look at the past recessions that we've had, they've pretty much all followed an aggressive rate hike regime, then a plateau, and then the recession kicks in, and then the Fed is scrambling to lower rates. And we have a multi-quarter, sometimes multi-year recessionary period that follows. Do you expect history to follow that script this time around? Sounds like you do. It
always does. It always does. The Fed's always wrong. They're always backward looking, and there's always lag effect to their numbers. And they're either too tight for too long, or they're too easy for too long. Lately we've seen the too easy for too long, and now most recently now they're tight, and they'll remain tight because they do have these inflationary effects that are going to stay with us. I think it'll be very difficult to get it down to their 2% target. So they're going to keep this higher for longer. So they'll keep it higher for longer, and those erosionary effects underneath the economy and corporations going bankrupt and having to cut back and lay off people and all that kind of stuff will continue on. So that's
okay. And as you've been talking, I put up the chart here, which shows these peaks where we have this plateau where the Fed has hung out, said, okay, we're done hiking, we're going to stay here because this is the right place to be. And then all of a sudden they realize, oh no, it's not the right place to be. We are way too tight. And then they scramble. So it sounds like you're saying, yep, here at the end of this chart here with the peak with the question mark, you're pretty your experience makes you fairly confident that we're going to see the same cycle repeat.
Absolutely. It really never changes. And I don't see it, given the circumstances that we have today, where we can see the erosion of the economy, yet the headline numbers kind of look strong. They'll continue to tighten they'll continue to be tight. And of course, they are still tightening with QT at $90 billion every month. So it's not just a pause here. We have a pause in rate hikes at what are very high levels relative to what we have been when you were at zero for over a decade. You go from 0 to 5 and 5.25%, 5.5% on the Fed funds, and you jump rates as high as you did, not just mortgages, but corporate loans, everything. They're all up. They're all doubled. There are going to be severe effects because companies and people borrowed record amounts of money. You saw credit card borrowing go to $1.8 trillion, up 16% year over year. Well, you're talking 21% rates there on credit cards. And
right, the highest amount of outstanding credit card balance paired with the highest average APR on credit cards.
Right, ever. So those effects are we're starting to see those in a slowdown in the economy, a slowdown in retail sales, and that will only continue. And then you can throw in, of course, the student loans, which have started to impact a significant percentage of the economy. They have these loans, and I saw where the average cost was $350 per month. That's going to be taking out here in the fourth quarter. Mm-hmm. So it doesn't look good for Christmas sales here at all.
All right, so let's assume for a moment, and showing my cards, I'm on the same page you are, Fred. But that the lag effect does tip the U.S. into recession next year. And again, while a lot of our cohorts globally are doing the same, thinking back to that chart that I just showed there, that shows that in the past the Fed has scrambled to reduce rates. Presumably, when the recession hits, if something hasn't broken before then, the Fed will probably stop QT, but tell me if you disagree. And then secondly, it'll start cutting rates. We're up here at 5.25-ish. How low? Again, I'm sort of forcing you to prognosticate a little bit here, but how aggressive do you expect the Fed to be in bringing the federal funds rate down? As aggressive as we've seen in previous regimes?
I think it depends on how badly the stock market is getting hit, and if there are, as you said, if there are any explosions that might occur like we saw in March. And to that point, those regional banks have bigger problems today than they did back in March, and the amount of losses they're holding on their balance sheet. Now they have the new program, the BFTP or whatever it's called, that helps that where they're borrowing from. But if that spreads and in recessions, that certainly could happen, and then you have some kind of a crisis, then that will speed their actions up. So I think it's a stock market, the big decline of which we're not having it right now, and certainly not today, and or some kind of crisis in the banking system that would speed everything up. Otherwise, they'll be slow.
All right.
Because of the trouble getting inflation down.
Got it. Okay. Well, let me read this and then let you run with your commentary. This was said recently by a smart man that I'm actually talking to right now. Moody's cuts the U.S. outlook to negative, citing deficits and political polarization. Late Friday afternoon, after the 3, 10, and miserable 30-year auctions. We're heading to such a train wreck, and almost all investors are 100% clueless. What could go wrong? So when you say that the Fed's actions are basically going to depend upon what we see happen in the markets, does not sound like you're very optimistic about what's going to happen in the markets next year.
No, and what we didn't talk about yet was the box that the Fed is in. We have the deficit. I was on this channel 7 months ago. The national debt was $31.5 trillion. It grew $2.2 trillion in just 7 months. It's staggering numbers. The government's only paying 3% right now on average on their debt. So that's going higher because Treasury Secretary Yellen is issuing many bills as she can at 5.5%.
Yep.
So that's going higher. And we're already at a run rate of $1 trillion in interest expense, or almost getting to $3 billion per day. So, there's a huge problem here that the Fed has. They have to keep funding this. all this spending that's going on, a lot of these programs that the Biden administration has started with the CHIPS program, infrastructure, the Inflation Reduction Act. These are all major spending programs where spending continues to actually build over the next few years. So, so now we have Moody's, which is finally, after Fitch and S&P had come in and down, although Moody's hasn't downgraded, they just warned that they were in a negative mode, and they would probably downgrade the debt of the government. This is a big problem, and the markets aren't considering that at all right now. The cost of debt is too high, interest expense, and there's no sense of any fiscal responsibility in Washington. They just keep spending. So, you could have a situation where longer term rates actually go up when the Fed is trying to lower rates some point next year because of these dynamics. The traditional buyers of in the last several years, the largest holders were the Fed itself, which is not buying.
Right.
They're reversing. They're letting bonds mature at $90 billion in total, treasuries and mortgage backs. So they're out of the market. China has dumped over the last several years from $500 billion worth of bonds, and they're doing it at an accelerated pace. So it's gone from 1.3 trillion to 800 billion. And the pace that they were running at now is $200 billion a year. And I know they're going to continue. I read it. I read comments from them. They're going to continue to dump. Japanese holders are selling now, and they are the current largest foreign holders. And what's making this up right now, what's making up the difference is what they call the household category, which is made up of people like me who did put short money into short-term. 5% plus is really good. So
right.
People like me,
it's that trend that's injuring all the banks, right? Which is everyone's
correct.
taking their bank deposits.
They're taking
out
the
of
money
banks.
out. That's correct. And that could cause, that's part of, along with their losses, which could cause further crisis. But also then you have this basis trade that's going on, where hedge funds are buying a huge. Now we don't know exactly how much. No one knows exactly how much, but we know it's levered. And just last week, I will read this comment from Lisa Cook, who was a Fed governor, talking about this basis trade. Because the basis trade is highly leveraged, a funding shock or heightened volatility in treasury markets could force some hedge funds to abruptly unwind their positions at potentially distressed prices. That's a Fed governor saying that. Now the BIS, the Bureau, the bankers to the bankers, the central bankers, warned also of a potential dislocation just relatively recently. So we have big problems potentially here. You just can't keep spending like this and borrowing like this. The great economist Herb Stein, said, if something cannot go on forever, it won't. It'll stop. Right. And that's what also is out there. There are these big, potentially huge problems that could come up, and likely will. We had the March madness where the Fed had to come in. We saw that in England not too long ago. And then the Fed has to react. That's usually what's been happening here over the last multi-decades, is that something happens that they don't anticipate, and then they have to come in again.
All right. Well, let me ask you to opine on this, right? So we've got the Fed pumping the brakes hard, right? Tightening QT rate hikes, right? Yet we've got the fiscal side, right? We've got the Congress and the administration hitting the gas, right? And I've talked about this a lot on the program. That's not sustainable, right? Just like if you were in a car and you jammed your feet on both the accelerator and the brake, you'd basically burn out the engine in not too long of a time. How does that manifest? And I've asked this question of a couple different previous experts on the channel. I've kind of gotten different answers, so I'm curious to hear what your thoughts are.
Well, it could manifest itself in higher long-term rates, and that would be a problem, or higher than they would like to see. And that may be part of what we've seen already, is that the rates are high. The Fed stopped hiking rates in July, and then longer-term rates went up another 100 basis points from there. Well, that was the Fed. That was showing the Fed losing control a bit. Now, it might lose a lot more control. You have all of these central banks that have we should say the countries that are dropping their bonds. Well, their bond holdings here, well, that could cause a problem, and then you could have a dollar decline. right now, we don't know how large the carry trade is in Japan. Some think it's enormous, but if Japan is forced to come off their yield control, the yen could, after it's been declining for significantly, could reverse, and the dollar could actually start to decline. And I actually think that will happen here at some point. Inflation's rising in Japan, and they're coming to the point where they're going to have to come off of that. So you could see a dynamic where the dollar declines too, which would lift inflation even higher here. There's a whole bunch of different variables that could occur that would upset the apple cart.
Okay, it's such an interesting tangle here. So the market this week clearly thinks that the Fed is done hiking, and that the next action the Fed is going to take is a cut. Now, that cut might not come till some point, into 2024. We can argue about when. We can argue about what might trigger it. But clearly, this week at least, the bond market is cheering this, right? It's had 3 years of declines, right? At least with treasuries, unprecedented, right? And so I think bond investors are all of a sudden maybe thinking like, oh my goodness, like maybe the beatings just ended, right? Maybe we're poised to have a good year next year. And of course, there's been a number of people on this channel who have been arguing the long treasury bond trade, which was, hey, at some point the Fed's going to be done, and then either willingly or reluctantly, the Fed's going to have to bring down interest rates in the way that we just talked about. That should actually be quite favorable for treasuries, unless inflation remains really sticky and high, and the vigilantes keep pushing up the further end of the long end of the curve. I'm curious, what are your thoughts right now on the long treasury trade?
If we were in normal times, where we didn't have these funding issues, or we didn't have this out of control spending, and we didn't, if that was not the case, we were just in a normal heading into a recessionary period, you would want to be buying hand over fist long-term bonds right now. And it may be, we have seen rates come down here. It may be that we will have a rally. However, the problem is that you do have this potential funding crisis. You do have a potential dollar crisis, and that could shoot rates up the other way. So it's a possibility, and you have to consider that possibility of that happening. So I'm mixed. Like I said, normally you should be buying bonds, but this is a different environment. This is uncharted territory that we're in right now. And so it makes me a little bit leery I certainly wouldn't be jumping in and buying these long-term bonds hand over fist at this point, because I do know that there are these problems that could keep rates up. Okay.
So there's sort of too much risk in the system right now. I believe kind of for everything you've told us so far, those are all reasons why you're a fan of gold. We'll get to gold in a bit. You're nodding as I'm saying this. Before I do, I in the intro, I sort of talked about these trend changes, right? And I think we have talked about the trend change that the hiking regime is probably done at this point in time. You're nodding.
I'd say for sure.
Okay, we've talked that bonds may be reversing here, and you're saying, hey, we could well get a rally in the near term, longer term murky, given what goes on with the additional reckless spending that's going on. Stocks. We touched earlier that you think that stocks probably don't have a great future ahead of them next year, especially if we go into recession. But specifically, the Magnificent Seven stocks have really what's powered the market this year, right? Yeah, it's like the S&P. It's like the S&P 7, right? If you look at the S&P 493, it hasn't gone anywhere this year, right?
Right. The Russell 2000, as of this morning, was down.
Okay, so here's something that you said. You said Magnificent Seven techs attract all the money in a wild FOMO-driven frenzy, taking valuations to beyond nosebleed levels, will eventually flame out as fundamentals do not support, right? So building off of that, some other things that you've noted recently. You retweeted a Bloomberg headline that said Apple delays work on next year's iPhone, Mac software to fix bugs. Here's what you said to that. Nothing seems to matter when the boys be wilding. 4 straight cuts of negative sales growth, 4 straight quarters, sorry, of negative sales growth, guide downs, extreme overvaluations, or this ultimately will end badly. Meta's CFO also talked about seeing weakness in their advertising revenues, which is basically how Meta makes its money. So, you know, when you look
and Google did too, by the way.
Google did too, right? Which makes sense. They live in the same ecosystem, advertising ecosystem. So we've had these kind of bulletproof companies where you're shining a light and saying, actually, they've got a lot of tarnish on them in a lot of ways. Apple, not only has it had, 4 straight quarters of negative sales growth, right? We're not talking earnings growth here. We're talking negative sales growth. That's top line revenues, right? And yet these companies still enjoy these fantastic PEs, and they still get the majority of the dollars that come into the market through just the passive ETF indexing. Is that going to, are they going to remain bulletproof, or are these warning signs that you're, you know, flashing a bright light on here finally going to start mattering next year?
They won't remain bulletproof. They weren't bulletproof last year. They got crushed.
Yep.
You saw, you know, Meta dropped 64% last year. Microsoft dropped 30%. Nvidia dropped 50%. It was down 68% at one point. Amazon was down 50%. So they weren't invincible then. And then we had a rally in October, which the market was oversold, and that was to be expected. And when we get these rallies in bear markets, as we've seen before, I've seen it, saw it in 1990, I saw it in 2000, I've seen it every time, 2007. When you're still in a bear market, you haven't transitioned. Usually you go, the old leaders are not your leaders, and you have new leadership. And you get capitulation in what were the favorites. We've not seen the capitulation, obviously. We saw a big decline. We then had that rally into October that was extended because of the Fed's $700 billion increase. And also, there was one other event that occurred around the same time in March, was the AI frenzy. And that got imaginations going quite a bit.
Right, that stirred up the animal spirits. Yeah.
Right, the animal spirits were going. And so they poured all into the AI plays, which just so happened to be mostly the Magnificent Seven types. So that had a big rally, but then we had another big decline. So we had a 3-month market decline, and these stocks all declined with it as well. Some less than others, but Apple took a pretty hard hit down to 160s, and when Google reported results just a couple of weeks ago, that had its biggest one-day decline in that 3-month period. Since then, we've had a 2-week just explosion of buying in these stocks. Once again, another surge where they go back into the favorites. Yet, you know, I put out my headline, the last newsletter I had, it was, Magnificent Three. I think I had a question mark, because the only ones whose numbers were holding up were Microsoft, which had a good quarter still. Amazon, although it was all much of their improvement was due to their largest layoffs in history, 27,000 people, and they just announced some more layoffs today in a business segment. And then also Nvidia, which hasn't reported but will in another week and a half, and they'll have fantastic numbers, which we can get into if you'd like. But all the other four were troubled. I mean, Tesla's earnings fell by 44%, and Elon Musk gave some very negative commentary going forward into 2024. And we know in their case, in EVs, that there's been a big buildup in inventories, and his sales of his deliveries have not come through for several quarters now. So
there's
Tesla was in trouble.
Pretty big sticker price declines too on the retail.
Well, because they had to. They've had to in order to drive the sales that they have done. And so a huge slowdown. And remember, Tesla is the most favorite stock amongst investors. It's the highest traded stock and the highest traded options of any of the any stock out there, even though it's not as large in market cap, but it's not $1 trillion market cap or more like some of the others. It's the most popular stock, and it has severe problems. And it's so of the Mag 7, that's the weakest one. And then you look at Apple. Well, as you said, 4 consecutive quarters. It's likely going to happen again in the current quarter. Foxconn just reported their October numbers, and they were down. That's the largest manufacturing partner, and they were down 5% year over year in October. In Apple's case, they have a new product line with iPhone 15, and they're highlighting the titanium aspect of the phone. Well, you've run out of colors now, and now you start talking about a titanium sheen over an aluminum base, and that's what you're highlighting because there really isn't much else. A little bit faster, a little bit better camera, and it's really a marketing scheme than anything else. You're highlighting titanium. Well, that's not going over so well right now.
You mean that's not a reason to drop $1,200 on a new phone?
No, and in fact, no. And the Wall Street Journal's tech reporter headlined a story saying you don't need a new iPhone. All you need is a new battery. Well, that doesn't help sales, and but that's a fact. So if the consumer is under pressure and they have this $1.1 trillion of debt and it's at 21%, you really want to go out and buy another new iPhone when there's nothing really there. And that's a problem. And then in addition to that, they have serious problems in China. So their revenues in China were running at 20%. And it was 24% the quarter prior to that. It dropped to 16 in the latest quarter.
Ooh.
And that's because the Chinese government told their government agencies and their privately owned not to buy iPhones anymore, as well as other Apple products. And one of the reasons that is that Apple's trying to move away from China. And so there's a backlash there. And also, we had put restraints on Huawei and almost completely killed them in the smartphone area. They were at one point, they were larger than Apple. It was Samsung 1, Huawei 2, and Apple 3. Huawei just got decimated when we stopped, when the suppliers couldn't issue them any components. Well, Huawei's kind of got around that over the last couple of years, and they came out with a Mate 60 phone, which was a big hit, and so that's hurting, and that will continue to hurt Apple sales going forward. So you have a big problem in China, and then to make matters worse, they went after Foxconn, the major manufacturer I talked about, with tax audits in many subsidiaries, and also looking at land use. So China's turned against Apple, and yet it was one of their largest markets. And that's only going to continue and get worse. The Huawei Mate 60 phone was only introduced in September, only had 1 month of sales, and it's been a huge hit. And then Qualcomm came out with their numbers at the beginning of this month, just a couple of weeks ago, and said that they were seeing a huge surge in Chinese component ordering. Qualcomm's the largest semiconductor maker for smartphones, and they were up 35%, indicating that Apple was going to be Apple's going to lose share because the smartphone market itself is still declining. It declined 1% year over year in the third quarter, and that was against a quarter before it was double-digit decline. So things aren't good there. One other point is that Asia Nikkei Review broke down the new iPhone, and they found that the components cost 10% more. So inflation impacting. Now, in the past, that hasn't been a problem because Apple's been able to raise prices.
Right.
But now that they're competing with more like Huawei, they couldn't raise prices this time except on one model. So they're going to likely take a hit here as they go forward from higher component costs.
Right.
So,
and so sorry,
that's your number one market cap company.
Right. So more competition from competitors,
Right.
higher input component costs, which brings
Right.
down their profit margin, plus weaker consumer demand. That
Right.
is not a good mix.
No. And then one of the things that they've been bolstering the bottom line. So they're still showing growth on the bottom line, even though they don't have any growth on the top line. One of the ways they've been doing that is through share buybacks. But they're not generating the cash that they used to. And there's so many shares outstanding. Well, the market cap is so big that when you do $77 billion, it's only it's 2%. So it doesn't move the needle any longer. And in fact, that buyback came down. People talk about Apple, well, they have $162 billion of cash on the balance sheet. Well, yes, they do. But they also have $110 billion in debt that they poured on in order to buy back all these shares. So there's a net of only $50 billion. And that's fallen a lot. And this is the first time I've seen this, that their buybacks were significantly less, 16% less in dollar terms versus last year. Last year they did 90 billion in buybacks. This year was only 76 or 77 billion. So the buybacks itself are smaller on a $3 trillion market cap. So you don't have that lever either anymore.
Wow. I'm going to ask you a heretical question here, which is Apple a short?
It's my favorite short. That and Tesla. I think those are the two most at risk. Now, when I say, is it a short? Well, for me, I don't short outright. It's very difficult to short in a money printing environment because the Fed could come back in again and we could see higher valuations nominally in the market. That's what happens in money printing periods. So I only do it via put options. That's it. I limit my risk with put options, but it is my biggest put option position.
Great. And I'm guessing you're doing longer dated put options? Like you're not
Yeah,
betting on Apple
I'm
crashing
out to mid 2024. So I want some time. I want some time for the economy to continue to decline. I want some more time for the Fed to pull more money out of the system, making, it's like Jenga, you're pulling blocks out and then you'll get to the capitulation phase, and it might be in the middle of next year, and that might be very good timing.
Okay. I want to remind folks what I said in the introduction, which is that you are the publisher of the High Tech Strategist and have been doing that since 1987. So your analysis of the tech space isn't sort of just some guy in the internet's opinion. You are one of the top analysts following this sector for the past 40 years.
Decades.
I mean,
I've been doing it for 40 years. It's since 1979. So it's I've been invested in the group since 1979. So that's 45 years to be exact.
Wow.
Almost 45
right.
years.
Yeah. So my point is, folks listening, you should place a lot of weight on what Fred is
that's where I
here.
spend most of my time in that area. And I didn't get into we talked about smartphones, but also PCs. And people think that we hit a bottom there. Intel made some positive comments. Taiwan Semiconductor made some similar kinds of comments. But I just had the three largest distributors of computer products report results in the last 2 weeks. One of them is CDW. It's a $22 billion distributor of computer products, so networking, hardware, PCs, all of that. 250,000 customers, and these are corporate and small business customers. And this gets back to the erosion in the economy part of it, but also ties into tech. What they saw was a worsening of demand, not an improvement, not a stabilization. It was a worsening. So they had, in the prior conference call, which was for the Q2 numbers, they had said they had seen some glimmers of hope, some early signs, and those reversed on them. It got worse everywhere. It got worse in their international sales. It got worse in domestic sales, worse small business, worse corporations, commercial, everywhere except for public government.
All right.
And in cloud, which is still growing, 20% for them, and also security. But all of the hardware categories were down double-digit percents, including PCs, which are 15%. And Insight and PC Connections said exactly the same thing. So people thought they were going to see an improvement, thought they had seen stabilization, and in fact reversed. That makes sense if the economy is still turning down.
Got it. So you're basically saying from your perch in the tech world, and tech tends to be a leading industry, you are seeing the lag effect in action here. You are actually seeing that gravitational force begin to pull down business results.
Right. Before it was just consumer, because we had a big surge of consumer spending around COVID, and then those people didn't need to upgrade their systems, didn't need to upgrade their PCs, and so we saw a big consumer decline. What we're seeing now is worsening around the world of business customers, and that's a much bigger market than consumer. And that's what you would expect to see when these companies are under pressure, when their interest expenses are higher, and many of the zombie type companies are going to go out of business.
Okay. All right, two last macro questions, then I want to get into, okay, so how does the average viewer who's watching all this and maybe a little bit freaked out now about your somewhat dark outlook, what should they consider doing about it? Inflation. I think we sort of danced around this a little bit, but what are you expecting for inflation? Right, so CPI is coming down. I talked about that chart, which I haven't found yet, but I'll try to find while you're answering. It shows how CPI tends to follow M2, but
and M2 is falling.
And M2 is falling.
Mm-hmm.
But it's an important, but maybe an overly simplistic way to look at it. I'm curious, do you see the inflation fight as all over but for the crying, or do you think it's going to be stickier than maybe today's data suggests?
We're seeing very small amounts of money supply declines right now, but we had seen a 50% decline in over a 3-year period, 40% over 2 years during COVID. There was an enormous amount of money that was put into the system, and that really, part of inflation is inflation expectations. And so what I had said about the University of Michigan consumer inflation expectations rising in the latest report, that's not a good thing. But if you look, oftentimes once you let inflation get out of the bag, it starts to get going and you get inflation expectations rise, people start demanding higher wages. So what are we seeing? Well, we 25 to 30% increase from auto workers right now. That's the deal. And those are unions, but just in the last few weeks now, Hyundai had to come out with that was this week, 25% increase in their wages over the next several years, 5 years, I think. Honda increased theirs by 11%, Toyota by 9%. Those are immediate increases. And you had UPS had big wage hikes. My brother-in-law works for FedEx, and he's telling me we're way underpaid. We'll be next. We'll get our big increase.
Well, after seeing what happened with UPS, absolutely, you can imagine this. The first thing they did was go to the manager's office.
Yeah. So, we've seen it in healthcare. We've seen it in service workers in Las Vegas. There's more union activity than we've ever seen in years and years and years, and they're all getting higher wages, and that's why that Atlanta Fed wage tracker at 5.2% is meaningful. In addition to that, healthcare costs continue to rise. The Mercer group, which monitors these things, they're predicting 6.5% increase in health insurance costs, I should say, in 2024. And then PwC just came out with a forecast for 2024 of 7% increase in medical costs versus 6% last year and 5.5% the year before. So you can see these are major components of inflation: wages, health insurance, healthcare costs, and they're all rising. And people's expectations for inflation are there too. And that's why I think it'll be very difficult to get the inflation numbers. I knew the inflation numbers would come down. I knew that would happen. There were shortages, supply chain problems, base effects where it would decline as a result of that. Energy prices would come down off the top, which they did, but those are all done. And now you have these more persistent declines because inflation expectations have been released. Okay. So I don't think it's going to be easy to get to the 2% target rate that they have.
Okay, and folks, I'm just putting up that chart of CPI versus M2 that I mentioned earlier, just so you can see the trajectory that we were talking about. Now, of course, Fred has just thrown a lot of sand in the gears of this simplistic argument to say, hey, there's a lot of things that could support inflation going up from here. Fred, let me just ask you to square part of that circle with me, which is take that, which everything you said is absolutely happening right now. Don't disagree at all. But if I share your prediction that we're going to have a recession next year, and maybe a pretty serious one, a lot of that stuff can get unwound in many ways by a serious recession. right? Demand brings down a lot of good prices, brings down a lot of service prices. Yeah, maybe you can't renegotiate those wage contracts quickly, but you sure can lay people off, right? So you can be paying your average worker more on average, but you just have less average workers, right? So
I just think
what
it'll
do you
be
think that
hard to
dynamic's
get
going
to
to
the
be?
two. What I'm saying is it'll be because of these other pressures and potentially also the dollar decline, which I think is almost certain. On a purchase power parity basis, the dollar is way too high. So that would be inflationary as well. Those pressures will make it difficult for the rate to come down as fast as some people think it will. I wouldn't be surprised to see it come down. I would expect it to come down unless something happens. I would expect it to come down, but not to get it down to 2%. That's where it's going to be difficult. So in a recession, now if it gets to be the really severe part of a recession, the Fed will come back in and they'll print again, and then you might get that wave effect that we saw in the 70s, where you kept going, you went down for a while, and then you went back up again, and down for a while, and then went back up again. And as long as they still think this quantitative easing tool works, that's probably what you're going to get.
Right. So that's the Arthur Burns effect that Powell is frightened of here. Just to give you some further ammunition, Fred, that's the path that Felix Zulauf sees us being stuck in for the next decade. He calls it the decade of the roller coasters, right? We keep doing this. Now, not trying to pick a fight here, but one of the reasons I was sort of digging around for your inflation prediction is the video, one of the videos that precedes you on this channel recently is David Rosenberg saying that he expects CPI to be at a 1% handle by the end of next year. Sounds like you think that that's going to be pretty tough unless we just had some horrific recession.
Yeah, David's a good friend of mine. He thought inflation was going, no disrespect to him, because I think he's one of the very best economists there are out there. He thought inflation was going to come down a lot faster. He didn't think he believed it was transitory, and it wasn't. And he's always been a little bit too optimistic on how far inflation is going to come. And I was not in agreement with back then, and I'm not in agreement with him. And that's probably the only thing I'm not in agreement with him on is his inflation forecast.
And that's fine. And look, as I always say on this channel, smart people can look at the same data and come to different conclusions, and that's what makes a market, right? Okay, so sounds like one of your most high conviction predictions from where we are right here is what you just said, which is that the dollar is way too high, especially on a purchase price parity basis. Can you first, just very quickly for folks that don't understand PPP, what it is and why you think the dollar is so overvalued right now?
Well, I look at the charts and they show it's like 30% over. So basically, it tries to measure what your purchasing power is for the dollar versus the yen or the euro, and what it really should be. And it shows that the dollar relative to the goods that you can buy elsewhere is overvalued. That's essentially it. There's a big MAC index where they actually measure MAC hamburger prices. That's another way of doing it. It seems to have worked well over time.
Sorry, that's not an acronym. You're saying it's the Big Mac Index, which is you look at what you can buy a Big Mac in McDonald's for in different currencies. Yeah,
in different currencies. That's right. Yeah, and so that's the Big Mac Index also shows the same thing, where the dollar's overvalued by about 30%, and it's only been at this level a couple of times before in the last decades, and each time the dollar's fallen rapidly. So a reversion to the mean, or what you would expect is that to happen. Right now there's, U.S. has 24% of the world's GDP, I think 2 or 3 or 4% of the world's population, and 60% of the money invested in stocks. Well, a lot of that's foreign money, and that money is in dollars. And if they start selling, as I expect they will, you're going to see, just as they're reselling bonds right now, the Japanese are, you're going to see weakness in the dollar.
Okay, and so again, I believe that's one of your higher conviction positions right now. So now moving into, okay, so how can people sort of position themselves for the type of future you see coming? Obviously, they'd want to be positioning themselves for a future where there's a weaker dollar. I believe that's one of the main tenets for why you're bullish on gold right now. True?
True, absolutely. You know what you ought to do, though, too? You should put up that first chart you had of the Fed pauses. We should do that because that's
Okay.
important to the gold story.
All right.
You can find it there.
You talk and I'll bring it up while you
Okay,
talk.
so you showed that chart shows 3 pauses there. One was around 2000 timeframe, one was a 2006 timeframe, one was 2019 timeframe.
There we go.
Gold does really so. Okay, there's one in the 1980s there as well. But see the 2000, the 2006, and again in 2019. You see the 3 pauses there. Well, gold went up 170% right after that, 200 after 2000, and then went up further, a lot further. Obviously, it went up by 600%. And then 2006, it went up 270% on that pause, after that pause. And in 2019, it went up 150% after that pause. So we just paused and we just got a big rally in gold here. I don't think that's a coincidence. So that's one of the main reasons that you want to be long gold. In addition to that, you know, well, we do have sticky inflation. That is a positive as well. And then one of the big factors that I think is driving gold to ever higher lows and eventually to higher highs, because is this enormous demand that's coming from overseas buyers. So, you know, last year we had central banks buy 1,100 something tons of gold. This year, to date, they have purchased 800 tons. They're up, I think it's around 15% over last year. So they're running at a record pace again. Central banks used to account for 10 to 12% or so of world gold demand. It's now 25% plus. So central banks, and it's not just the central banks, and it's not just the enemies of the US who are buying this either, who are dumping bonds like China, but countries like Poland, which has purchased this year to date 111 tons. Now they've increased that by their positioning by 50%. Now Poland's a friend of the U.S. Some of these countries are buying because they're worried about the weaponization of the dollar. So enemies of the U.S. All of those BRIC countries are almost all of them are buying gold. But in addition to that, Poland's there. Singapore has purchased 80 tons this year. You have Czechoslovakia's increased theirs by 125%. These are all friendly countries to the U.S. So all around the world, they're buying gold. And part of the reason is that they see, you know, we just had all these downgrades of the debt, and they see the problems here. They see the lack of fiscal discipline, and they see the deficits going crazy, and they want to protect themselves as well. So all that demand has been growing and growing and growing. And you know, and some it may even be higher because China doesn't report everything. The Bank of China doesn't report. Sometimes they don't report at all, but lately they've just been reporting less than they're actually buying, based upon what I know and we know. But also Saudi Arabia is not reporting yet. We know they're buying too. So all these central banks are buying gold, and it's lifting the lows, higher lows on gold. So in 2015, where we bottomed at 1050 gold, we then went up into 2018, the 1180 low. Last year's low was 1610. This year's low is 1820. This is all being done without any real Western demand. In fact, it's negative demand. The GLD ETF, which is the largest ETF, currently has only 800 tons in its holdings. It's down 410 tons from where it was just 3 years ago. And the IAU, which is the second largest gold ETF, is down close to 30% in their holdings. So these are Western based, so mostly US and Europe. And they've been dumping gold.
Yeah, starting to interrupt. Let me just ask this question because I have trouble understanding it, which is why? Like, we just had massive inflation, you know, for the first time in decades. You would think people would be rushing out to buy gold.
Because everybody's chasing the Magnificent Seven. And that's what happened. That's what happened. Gold does well in times of turmoil. Gold does well when the stock market is not doing well. In the 1970s, the stock market was a poor place to be, but it was a giant gold market. In 1980 1980 to 2020 to 2000, people were chasing, the tech stocks, especially in the end in the late 1990s, and gold was abandoned. Same thing. And gold was a 20-year bear market. Then we had a big decline, a couple of big bear markets in 2000 to 2002, and then again in 2008. And gold had a massive run. Gold went up, as I said, 600%, and the miners went up 1,600% during that time. So, and then we went back into the Magnificent Seven here in these recent years. And so Western investors have been abandoning it. They don't see a need. They think they're in the Goldilocks environment where inflation is okay and the economy is going to keep growing, and they have belief in the central bank. They have belief that the Fed is in control, and I don't know why anyone does, but they do. And they want to believe. They want to, and that's why they keep going back, keep buying the Magnificent Seven. They want to believe everything's okay, just as they tried to do the same in 2000 with tech stocks. So when they're buying Magnificent Seven, then no interest in gold in the West. But if you think the Magnificent Seven, companies like Tesla can't sustain its market cap, or Apple can't sustain a $3 trillion market cap, then if those start falling, there'll be much more interest in gold from the West. And so we've not seen, all we've seen is outflows, and the futures positions are also low. So the managed money hedge fund positions in gold are also very low as well. That demand, on top of the demand that's been lifting us to higher lows from overseas, could set you off on a real big run in gold.
Okay, great. So just because we're at the hour here and I want to be respectful of your time, I'm going to get to sort of the rapid fire segment to kind of wrap things up here. But so you just made a great case for gold. Is 2024 the year that the Western markets get the memo on gold?
I think so, because I think the Magnificent Seven is going to have a rough year. The economy is going to be weak. The buying overseas will continue. There's no reason that won't. The dollar will decline. That's also positive for gold. The 8-year cycle that my friend Felix Zuloff talks about, we just began that. And these next 3 years are supposed to be great. From a technician standpoint, the 10-year, over a decade cup and handle is perfect. And so for almost any aspect you want to look at it, yes. It's going to go, and it'll probably go for a few years. Okay.
And how are you, because I know you do talk about your gold views in your newsletter, which I love, that the guy writing the high tech newsletter is into something as low tech as gold. How are you recommending that people consider playing it? Is it more just owning the metal itself? Is it playing the miners, which give you leverage to the price?
Well, I think that given the situation that we're in and what the outlook is for gold and silver will follow. It's good to own physical metals, and so I own a certain percentage, personally. And some people say it could be 5 or 10%, or could be more. That's prudent, and it's insurance against all of the things that I just talked about if they occur. Obviously, much more speculatively, the miners, which will, I talked about the 2000 timeframe where gold went up 600%, but miners went up, 16 times, 1,700%. It also can go down. We've seen miners go down 75 to 90%. You have these kinds of huge swings.
Right. And there's a lot of mining investors over the past decade that have experienced that part of the ride.
Well, that's the problem, is they didn't come in 2002 into the miners like I did, right? Yeah. My first miner positions, they came in 2008, they came in 2011, always at the top, which is the mistake. You have to buy when they're hated, which is what they are now. The Huey to gold ratio is 0.108. It was 0.12 when we were speaking. It's gotten worse, and it's almost at a record low right now. When we spoke 7 months ago, it was 0.12. The 20-year average is 0.2, and back in the bull market days, they were as high. They averaged, 0.46. So severely undervalued to net asset value. They're hated. There's no interest. There's no volume. If you're a contrarian, it's the time to buy. But you have to be wary that they're a volatile group. On the upside, they generally do 2 to 3 times better than the price of gold, but they also decline that as much. I think it's a good time to do it. But it all depends upon one's personal position, what their responsibilities and all that are.
Absolutely. And as you know, Fred, on this channel, every video I tell people to, almost everybody watching this, unless they're super experienced already doing this themselves, especially in this sector, should be working under the guidance of a professional financial advisor. So you're not giving individual advice, and everybody needs to talk to a professional to find out what works best for them.
Correct.
Okay, so we've got your, sounds like you're very optimistic on gold and gold related equities. Sounds like you are pretty bearish on the big tech, the Magnificent Seven. You've talked about the Tesla and Apple are the ones that you're most bearish on out of that crew. Bonds, it sounds like you're guardedly optimistic in the near term, but there's a lot of risk out there, and it's not time, in your estimation, to go whole hog on the long treasury trade.
Right. I like the short treasuries. I have big positions in the shorts because I'm getting paid up to 5.5%.
And I just want to be super clear for folks. You're saying you like short duration treasuries. You're not saying to short treasuries. You're saying
short-term duration treasuries, out to 2 years or something. I don't want to take a duration risk there.
Yeah, I mean, best, I don't want to say best ever, but certainly best in decades for investors that want to get a positive real return with no risk.
You don't have to take a lot of risk there. That's the thing. It's really something to take advantage of, I think, right now.
Yeah. Any other potential, investment areas that have your attention?
I talked about how everyone's piled in around the world. It's piled into the U.S. stocks with 60% of all the market valuation. So that means that the rest of the world has been abandoned, and it has. So I'm not an expert in international. I own a couple of different names, but I'm not an expert in that area. But I know Japanese stocks are cheap and their earnings are improving, and they've done a lot of positive things. Corporations are starting to wake up, I think, over there. And so emerging markets are cheap as well. What's that?
Warren Buffett agrees with you, by the way.
Yeah, that doesn't hurt. So, look, if you have the ability to look outside, if you have an advisor that has expertise in that area, that's an area that should be looked at, I think, though it's not my area of expertise.
All right, great. Well, look, I'll wrap it up here, given that you've very generously gone over the hour. Fred, for folks that have really enjoyed this conversation and maybe weren't as familiar with you before this interview, where can folks go to follow you and your work?
Yes, so I'm on Twitter at HTSF Hickey. If you're interested in the newsletter, then you could send an email to us at the High Tech Strategist at yahoo.com. That's THEHIGH strategist as it's spelled at yahoo.com, and we'll send you all the details.
All right, great. And Fred, when I edit this, I will put up those URLs on the screen here so folks know exactly where to go. Folks, I'll also have links in the description below too, so you can just have one-click access to that. Fred, it's been wonderful. Folks, if you'd like to have Fred come back on the program when his analysis tells him that something big is about to happen on the path to what he's laid out for us here, please vote your encouragement for that by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. And please do subscribe to this channel if you haven't yet, because we're just new out of the gate. Every new subscriber we get helps us burn more brightly on the YouTube algorithm, so really appreciate your help there. Also, Fred is one of the greats, but he's one of the great lineup that we have lined up for you in the first couple months here already. Lined up in terms of people that we've already booked here on Thoughtful Money. To find out exactly everybody else who's on that list, as well as get my updates on what lies ahead for Thoughtful Money, go subscribe for free to my Substack over at adamtaggart.substack.com. Fred, I can't thank you enough. I'm going to let you have the parting words of counsel here for the viewers here. Any parting bits of advice for them in this environment that you see ahead?
Keep following you. I've been a fan for a long time, and I'm sure you're going to be extremely successful. You're already off to a great start, and congratulations on your new venture.
Well, thank you. You're more than kind. And Fred, I got to tell you, we just landed Fred Hickey on this channel. It's an amazing discussion. You're going to love it. No, thanks so much, Fred. Really appreciate the time. Look forward to having you back on the channel soon. Everybody else, thanks so much for watching.